Hi everybody, this is Eddie Gabor, Managing Partner with Key Advisors Group. Please like and subscribe to our YouTube channel. We try to bring some real-time educational data that is actionable, that investors with the right risk tolerance can actually apply to their asset allocation strategy, as well as sharing with you what our positioning is for our client base. And with that said, one of the biggest things I wanted to talk about today is what do you do as an investor if you've missed this last 4-week rally that we have seen. I was on live TV on the 20th of September. That was the day that the market was really taking a beating, and consensus started to come out and say this was the beginning of a bear market. One analyst came out and said this is the start of a 20% correction, and that put a lot of fear in people because some of these analysts are extremely well respected individuals, and when they make a bold call like that, sometimes as an investor, that could cause you to make an emotional decision with your asset allocation. Hopefully you're not one of them, but I happened to be on that same day, and we were sharing with the networks and their viewers that for our client base, we actually thought it was a great buying opportunity at that particular time. And we don't always say buy the dip, right? Buy the dip only works in certain instances, right? If it was the start of a bear market, you certainly don't want to buy the dip if there's going to be another 10 to 20% downside. So why did we have such a strong conviction that that was a buy the dip moment for investors with the right risk tolerance? And why did we do that for our client base? Well, there were a couple things that we were looking at very closely before we made that market call. Again, it was really opposite of consensus at that time, and I am a contrarian investor by nature, so many times we are going against consensus, whether it's our energy call we made in December or reducing risk in June and then dialing back the risk in September. And so on that particular day, one of the biggest things that we were seeing happening was when you lifted the hood of the fundamentals, the VIX, which is the fear gauge that many people look at, really wasn't spiking as much as you would anticipate if there was really going to be this huge market crash. So that was one thing in our favor. Secondly, were interest rates. I am a huge believer that the bond market is smarter than the stock market. And many times if you follow the bond market, you can see that there's been several instances where it kind of leads the market in regards to, for lack of a better word, I'll call it predicting what direction growth is going to go into from an economic perspective. 10-year bond was going up. Global bonds were going up around the world. That was telling us that maybe the market is wrong and we're going to get a reacceleration of growth in the fourth quarter and not this major drawdown that so many were predicting on that day in September. The other thing we took a look at was volume, okay? Volume on a down day, if the market's down 1,000 points or 900 points on the Dow or 3 or 4% down on the S&P or the NASDAQ, whatever it may be, there has to be a lot of conviction, in our opinion, to really support that. There really wasn't a lot of conviction in volume. On the down days, the volume was not really heavy like you would expect it to be, and on up days, volume was accelerating. So we had low volume on down days. We had the yields really increasing. And we had consensus telling you to get the heck out because there was going to be this major drop in the markets. And so when we took a look at those fundamentals, it was really telling us the opposite story. So hopefully you were watching us on that day, and hopefully it made sense to you as to why between the VIX and rates and consensus and the volume that we weren't panicking and we were actually buying for some of our clients at that particular time. Now, let's say that you were not one of those that actually bought, or maybe you even sold on that particular time period. So what do you do now? We've had a pretty nice rip rally since that last week of September. And one thing that I would say, and again, everyone's situation is different, is you don't want to chase it, okay? There are some times as an investor that you just have to admit that you were wrong on your short-term call. I certainly have been wrong plenty in my career. And when you're wrong, you just kind of have to regroup yourself and wait for that next opportunity, okay? And we think that it will present itself sometime here in the fourth quarter. We're not going to get a gift like we did in September. That's our opinion. We think the sell-offs here in the fourth quarter will be more shallow in nature, maybe 2%, 4% if we're lucky. I'll be shocked if we hit that 4%. So as an investor, what you have to do right now is not chase. That's our opinion. And again, everyone's situation is different. And so not chasing means don't get FOMO and buy at the absolute peak, right? The market, as I'm recording this today, is at a pretty high level. And again, we've seen this rip rally over the last 4 weeks. So patience, patience, patience. It's the hardest thing to do as an investor because sometimes people want to be fully invested at all times. But what I would say is at this particular time, you need to sit back and see how you ultimately want your allocation to look. If this fourth quarter has the reflationary trade that we're expecting, we think some risk assets could do extremely well. And of course, we could be wrong as well too, which is why risk management has to be top of mind awareness anytime you're doing this. So patience means go ahead and put an allocation together, whether it's you want to put X amount of percentage in energy, X amount in crypto, X amount in small caps, X amount in technology, and build out your allocation that you want it to look like when you're fully invested. And incrementally start buying on these down days that we may get here in the month of October, end of October, November time period. Again, there's no guarantee you're going to get that opportunity, but very rarely do markets just go straight up. There's usually some opportunities, and they usually come when you least expect it. And right now, after this big rally we've had, there does seem to be some short-term complacency in the marketplace. So we think that you will more than likely get an opportunity to buy at a lower level than where you are today. Okay, so the key is patience, but have your strategy in place now. Know where you want to be so that way when you get that opportunity, you're not scrambling. You can go ahead and incrementally buy and dollar cost average into that ultimate strategy that you've built out for yourself and your family. Okay, and I believe if you stay with that discipline and show some patience as an investor and try to ignore the noise and just focus on the fundamentals like we try to do and focus on your fundamentals more importantly, that it will get you much farther in regards to your wealth strategy for you and your family. So hopefully if you missed this rally, you will get an opportunity here in the next couple of weeks. Again, we think it's going to happen, but we'll have to wait and see if we're correct. Okay. As always, please send me any messages to my inbox. I'll make sure I address them on our future videos when I push them out each week. And again, don't forget to subscribe to our YouTube channel. Thank you.